Let's talk a little bit more about earnings season as we get that ramp up. It brings along the usual volatility we've seen in stocks. We've seen some beats. We've also seen companies that miss on the top and bottom line really punished by investors here. Joining us now to discuss, Julian Emanuel is the Senior Managing Director and Head of Equity, Derivatives, and Quant Strategy at Evercore ISI. So Julian, let's start with a stat you had in your note today about the way companies are being punished for that double miss, and if anything that says to you about sentiment on the street and just the way we've seen markets acting over the last couple of weeks.
Well, so obviously the volatility across markets broadly is higher these last several weeks, and that is sort of in line with our more cautious view in the near to medium term. But when you think about earnings, actually the violence, both in terms of beats and misses, was something we saw last reporting season. And obviously, it's very early. A small preponderance of companies have reported. But to your point, the misses have been punished, which is what you would expect in a more hostile type tape that's pulled back the way it has. But to us, the bigger message is that the companies that have done well in some cases have seen their shares perform poorly. The world's leading money center bank, which reported a week ago Friday, really a case in point. It's the double beats, the ones beating on both EPS and revenues, and the share price reaction that is less than stellar, in some cases outright poor. That's what really tells us that the broader market is having digestion problems in and around this earnings season.
What do you think the underlying factors behind those digestion problems, Julian?
Well, I think it's two things, Julie. Number one, what you're seeing is this sort of bifurcation between shares that have been really driven by momentum, perhaps over and above, what a typical financial stock or what have you might have. Obviously, the semiconductor names, and to the point, the news out of Taiwan overnight sort of clarifies that, and you've seen that in the prior day, the news out of the Netherlands, et cetera, that the momentum names have just gone too far. But when you think about it from an overall market perspective, the S&P 500 is trading at about 23 times the last 12 months earnings. So basically, given these extended valuations, even good news may not be good news, particularly in these names that have run as far as they have.
And Julian, I'm curious over the last couple of weeks here, with looking at 4750 on the S&P at the end of the year, a lot of your colleagues in the street have been raising their price targets, probably a lonely place to have been. What has been the pushback that you've gotten from folks? And is this, tape maybe acting the way that, you and your team have thought it would as we got through that really euphoric first quarter of the year?
Well, that black eye I had has only cleared up in the last several days, and I hate to think that a market sell-off would help it heal. Look, here's the thing, right, is that when you think about the underpinnings of the Goldilocks environment that we have been very fortunate to be a part of, most particularly since the Fed's pivot in December, which at the present is looking less and less, call it pivotal, since we've gone from pricing in 6 cuts to then pricing in 3, and now pricing in below 2. And the problem with that is the market was able to digest going from 6 to 3 because the Fed always promised 3. And now we're not so sure about 3. We're thinking 2, 1, or maybe even 0. That's a headwind. Earnings are a headwind. The expectation for 2024 is north of 10% growth. That's why if you don't, raise the bar even higher, regardless of how you reported the most current quarter, your shares are going to be, probably subject to weakness. And then again, the last thing I would say is, look, we saw a lot of FOMO in February and March. The public put money into stocks, the speculation in options, and then, frankly, the momentum names peaked in March. And when that leadership begins to transition, and it's transitioned towards energy, that tends to be a headwind for stocks more broadly.
Julian, well, I know you're watching those momentum names and the rollover, but you are also watching something decidedly more old school when it comes to stock market analysis, and that's the Dow Jones transports and the relationship with the Dow Jones Industrial Average, because traditionally the trans index leads the overall index, and you're seeing the transports break below the 200-day moving average. So how big a deal is that? How much does it tend to be an indicator of what's happening next?
Well, it is imperfect, okay? But to your point, it has been around for well over a century. And when the economy was far less complex than it is now, divergence between the industrials average and the transports tended to mean that you were going to get incipient economic weakness. Now, again, this is a totally different world. The dominance of technology certainly reinforces that point. But in an environment where, the underpinnings of monetary policy, the persistence of inflation, the concern with valuation, let alone geopolitics, are all things that we think are more than fully priced in terms of all going well. This is just another sign to us that if, in fact, the economic data were to turn negative, it would be something really to pay attention to, because stocks themselves, the transports, are telling you that that's a distinct possibility.
And Julian, we've talked a little bit about it with that Fed pivot. You just mentioned the pressure on valuations. How are you looking at rates at this point? Particularly everyone has maybe, if you do, some people have a level on the 10-year they point at as a certain area of bother for stocks. How have you thought about that outlook, especially what we've seen, especially at the front end of the curve over the last week?
Right. So if you think about it, the rate story, going back several weeks to the peak of the market, is very similar to the rate story that triggered the sell-off last July. You approached 5% on the 2-year. You nudged up towards 4 3/4, and then ultimately 5% on the 10-year. And the reason it might actually be even more of a concern at this point is because of that implicit promise that the markets have traded of recuts now dialing back. And if you look at it, going back to March, I think it's a lot more than coincidence that the market rolled over from the highs literally precisely at the moment where the market started pricing in fewer than those 3 promised cuts that the Fed was going to promise us.
So, Julian, put it all together for us. What do we do with this, right? What do we do with this idea that this is going to be continue to be potentially a difficult digestion? Strategically, where should people be in the market?
So, for most people, this is not a major make huge portfolio changes. What we would say is the following: you want to probably tilt a little bit more towards defense. Most people, they look at their portfolio and they're probably underweight healthcare and they're probably underweight consumer staples. Own a little of those in case there is, in fact, a slowdown in the economy. And then the momentum names, we all know what they are. Look, you have to make a choice between hedging the volatility, riding it out, or, here the thing is that particularly with AI convex themes, we think they have long-term durability. But if you see a name that declines 10, 20, 30, 40%, you tend to get carried away by emotions. So the key there is either use options to hedge if you use options, or get to a point in your holdings of those very volatile names where you're going to be able to sleep and ride out the long term. And then the last thing, look, if there's anything that's a positive about the last 3 weeks and the Fed's promises being dialed back, is that we're still getting north of 5% on cash in an environment where inflation is 2.8%, which is too high. But the math of that still works to have cash as a part of your portfolio.
Lots of actionable advice for investors. Love it. Great to see you, Julian. Thank you so much.
Thank you.